Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, I'm going to provide a market update with returns to the end of July. I'm recording this podcast on Tuesday, August the 4th. So happy summer. Still 2 more months to go from my perspective. I have no kids going back to school, so I can say that. But for those of you who are pondering back to school, enjoy the last month here for you. And I'm going to go 2 more months of summer. So anyway, as a brief legal disclaimer, our discussions here should not be construed as financial or investment advice, and each person's situation is unique. All right, let's go. So the monthly update, when you follow the usual format, I'm going to give you the abbreviated summer version, and so it'll be a little short and sweet this time, but give you the same information that you need to go. So on the screen right now, you're going to see our usual table, which is the monthly returns along with the year-to-date returns and then 3 to 5 year annualized. Looking at the monthly returns for the month of July, pretty much in summary, the equity markets, the safer large cap and developed markets were more solid than the small caps and the emerging markets underperforming. So specifically, U.S. large caps were flat, let's call them flat for the month, while the U.S. small caps were down 3%. And then switching over to the international market, the developed markets were up 2%, I'm rounding a bit, while the emerging markets were down 3%. So one thing to note, and I think I mentioned this in the past podcast, but emerging markets have a South Korean component to them, or similar to the U.S. market with being dominated by the AI market. South Korea also has a very strong couple of large companies dominating the returns and the chip makers, and so the emerging markets have been moving around quite a bit, but it's actually following the AI story a little bit with the South Korean weight to it. So that's the U.S. equity market. Well, I guess the REITs, so a component of the U.S. equity market, the REITs are up 2.5%, and again, looking over, 20.6% on a year-to-date basis, which is the second highest, just trailing the commodities by a little bit, which is pretty shocking to me, given interest rates continue to rise. We'll talk about that in a second with the Federal Reserve. So REITs are having a very solid month. In fact, did they have the strongest? No, I guess short of the commodities and Bitcoin at the very bottom there, but REITs were the highest performing non-alternative asset class for the month. However, looking down at the bond section, so a lot of orange and red there. The biggest red there, the long bond, treasury bond, were down for the month alone 4.5%. So that gives the year-to-date return, minus 3.5%. Again, I do show on the middle section there the treasury bonds. I show the short end, the 1 to 3 year, mid-market or mid to long, 7 to 10 year, and then the long end, 20 plus. I do that for a couple of reasons. One, I like to geek out on bonds, but 2, it shows the duration. And so the longer the maturity, the more the bonds will lose when interest rates rise, but also gain when rates fall. So you can see there, interest rates, they rose a bit more on the long end, but long bonds down 4.5, the 10 year down 1.4, while the short end was flat, actually up slightly. So that actually interest rates rose on the short end, but you get that bond coupon, so that offsets some of the losses. Jumping down to the corporate side, just looking at the numbers there, nothing really jumps out. I guess the higher quality stuff, just looking at the numbers there, yeah. So municipal bonds and investment grades had the down 1.7, let's call it, rounding a bit here and there. That's tracking the higher quality treasury market, if you will. And then finally, the very, very bottom row, last month, those two were the big negatives, the big reds. This month are the big greens. And so commodities, that's going to, this year to date, this year anyway, the story has been all about oil and Iran. So they had a pretty tough month. Oil fell on the back of positive Iranian news, Strait of Hormuz news. And then this month, oil is going up. And so commodities going up quite a bit because things still aren't resolved and the Strait of Hormuz is still closed. And so that's been the big driver there. And then cryptos, again, Bitcoin here, we use the Bitwise ETF as the ETF that we can grab to track that. That was up 7%. So again, nothing really jumping out other than similar story where the fundamentals remain strong. I guess it avoided, I was going to say it caught a bid, but more accurately, I guess it avoided a sell-off. And so again, it's been flat. Looking at the year-to-date number, they're down 28% year-to-date. That has been it's just been a rough start to the year. And so if you look at it relative to, say, early February until now, it's pretty much been flat. And so, which again, has been a painful year-to-date return, but it's been holding steady. So anyway, that's a summary of the table. Now, if we jump over to our usual graph, which is going to be the year-to-date returns of the ETFs. And so let me pull it up on my screen here. Give me a second. So again, the what I like about this graph is it shows you not only the ending point of these different asset classes, which the table just showed you, but it shows you the path getting there. And so looking at it, again, you saw the commodities on the previous table was up the strongest, and you can see the green line there, and that's going up, pretty solidly. I think it was 7%, if I recall, on the table right before. So, and the magenta line, got that in, magenta, got to say that each time, right, Maura? Magenta line was down, but that's the emerging markets. But again, I mentioned the year-to-date numbers on the previous table. Yes, markets were flat to weak for the month, but pretty solid, impressive year-to-date numbers. And so let's just keep that in mind. I guess nothing jumps out. I don't have a special graph this month, but a couple things to note. Definitely the info, the technology sector, and the momentum trades were the big negatives for the month. And so those were down. I think the infotech sector was down 3.5%, and the momentum factor was down about 11%. And then on the flip side, energy, we talked about commodities here. So energy was the strongest sector. I think it was up about 11%, and financials were up about 6%. And so on the sector side, those are the strong ones. And then on the factor side, factor meaning taking the U.S. equity market and breaking it up into 4 or 5 like main drivers of it: momentum, quality, value. I'm drawing a blank on the last two, but the value factor was a strong driver as well this past month. Again, I think energy and financials being big contributors. So that's a brief summary of the U.S. equity market and what's one of the. I'll talk about something that happened in the equity market at the end of the month in a second, but let's first talk about interest rates. And so let me pull up now on the screen. You're going to see the graph of the yields. Again, on my blog post, I've got both the 1-year history and the 30-year history for more context. On the screen here, you're just going to see the 1 year just to give you a little more granularity to see what's going on. So in general, take a look to the far right, and it may look like a small move, but for bonds, it's a pretty big move. And so I'm going to talk about the Fed next in a second here, but you can see interest rates rose, especially the very last month. So the Fed meeting concluded on July 29th. And so you'll see just at the very, very end is where interest rates rose quite a bit. And so, overall, rates just remain higher for longer, and rates are up. So just rattling off the levels, I'm going to go 2-year through the 30-year. So the 2-year month end, July month end, up 4.28% for those who are not following along on the videos here. 10-year is up up to the level. So again, 2-year level is 4.28. 10-year level is 4.75. And yes, the 30-year, that's correct, 5.27. So the 30-year, I think that's been the highest level since back in 2007. So prior to the last great financial crisis. And so interest rates remain high. I'll talk about the Fed in a second, but that's just the main thing. And again, the magenta line there is the BBB corporate, 5.63. So again, it's going up with underlying treasury rates, but credit spreads have not moved out very much. And so again, it's the credit markets remain muted and chugging along, but underlying interest rates remain high for sure. I haven't seen, I don't have a graph for the mortgage rates right now, but I saw, I think it was last week, they just put out the weekly average. And so I think it was starting to get above, 6.7, 6.75 for 30-year mortgage rates. And so, I'm talking about mortgage or interest rates. What does that mean, Kirk? I don't care. Well, you should care. One, if you're looking to buy a home, mortgage rates are going up. And then again, interest rates on credit cards, definitely make sure you pay them down. They're sky high right now, and it's not getting any lower with these rates. And so that's a brief summary of the bond market. Now, related to that, let's talk about the Federal Reserve. So I don't have a graph to show you here. So the second meeting of Chair Warsh concluded on July 29th. He again did not give forward guidance, as he said he wouldn't. The statement was pretty short and sweet, just the facts. So I guess the couple of main takeaways. One, they did not raise rates. And so there was, the market was wondering if they would, with inflation starting to pick up again with the back of the commodity prices and the Strait of Hormuz being closed again. But they did not raise rates. But however, 3 of the 12 voting members wanted to raise rates, wanted to hike rates by a quarter point. So there were 3 dissenters, it's called. But again, rates stayed the same. And then in the press conference, Chair Warsh reiterated, again, they are focused on getting inflation down a 2% target. 2.0. There was some talk after the first meeting. Was he like, well, okay, a 2 handle is 2.5 okay? Is 2.3 okay? He reinforced that no, the Fed wants 2.0% inflation. So they hit that pretty hard again. But then what the second part of the main takeaway of the second part of the meeting was, well, then why didn't you raise rates? Because inflation remains high and is turning around and going higher. So a lot of some of the questions were asked like, well, you're saying this, but why didn't you take action? So definitely his Chair Warsh's perspective is going to be patience. And also from his perspective, even though the Fed didn't raise rates, the market did. And so I recall at the first meeting, he said he doesn't want to lead the market. He wants the market to react to the data. He doesn't want the market to react to what the Fed is thinking. And so from his perspective, rates have been raised. The market has done that for them. And so, which there's 2 or 3 or maybe plenty of views on that, but I lean more toward Warsh's camp on that, is that the market is raising rates, and so that will tighten things. We'll have to see if they follow through with the rate hike at the September meeting, but that was the summary of the meeting. And Fed funds futures market, again, don't have a graph this month, but it's coming back up in terms of looking at by year end. Will there be likely a 1 or maybe even 2 hikes? It's expected by year end. That's still priced into the market. So we get a couple of data points. Again, the next meeting isn't until the end of September, so we're going to get two CPI prints before then. So that'll have plenty of information to act upon. And then finally, my special topic this month could have just been happy summer. Let's get out of here. But at the end of July, I'm trying to think. I was out of town. Let's just call it Wednesday and Thursday. So the Fed meeting was Wednesday. The markets are pretty choppy around that, but there were definitely a couple of technology names that were just getting clocked. Prices falling quite a bit. And then news came out on Thursday that a hedge fund was going under. Citadel stepped in to clean them out, picked them up, and then things stabilized and the market actually rallied going into month end, and it still is rallying here on Tuesday, August the 4th. So situational awareness, that's not a joke. That was the name of the hedge fund. So situational awareness was a hedge fund that they were big into AI, which again, that's been the big story, but and again, all good things go on great until they don't. And if you have leverage, they don't even faster. So they were an AI hedge fund, grew just tremendous growth, but they also added quite a bit of leverage. They were about 4 times levered. And so think of it, you got $100 that you invest and you buy $100 of something. And so if it's up 10 or 20%, that's an unlevered return. Well, what if you borrowed $300 more and bought $300 more of exposure? So they were levered up, actually 4 times they were levered up. So sorry about that. But then when things turn, it can turn pretty quick on them as well. So they were some of the names you may have, if you're investing in AI, you may have felt that, these names were getting hit pretty hard, pretty quickly. That was some technicals going on with the unwind of this hedge fund. I think it was about a $45 billion at its peak. Got down to $30 billion, and I think the Citadel swooped in at another discount, I'm sure, to take it off their hands. And so anyway, that I guess the main point there, again, the market rebounded very quickly, so nothing to see here. Let's move on. I'd say just be aware of, when things get stretched, be aware if there's a bunch of leverage built into the system as well. Things can turn pretty quickly. And so still don't give it the all clear. I don't have some good data on the how to capture all the leverage in the system, but there's definitely quite a bit in it. So this was a good example of what could happen. It didn't extend, which is good, but leverage is out there, and just be careful. So anyway, so that's a wrap on the month of July here. Again, overall kind of a flat to mixed market. Again, large caps and developed markets doing better than small. And then, energy is rallying again as well as crypto. So, and interest rates, watch interest rates. These are pretty high levels. We'll see if they come down, but if they don't, it just continues to weigh on the activity as people have to borrow money. The cost of funds continues to remain high for some of these firms. So nothing witty to say other than, again, happy August, happy summer, and that's a wrap on today's topic. Thanks a lot. Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.